Thanks for checking out this module in the VRPAC's investment training series. This module deals with stock investing and is part one of two. I'm Jerry Versput, President and Principal Wealth Advisor for VRPAC's Financial Management. In this module, I'm going to talk about the philosophy and logic that goes into our approach to stock investing, and then part two will delve into specific strategies. As with all of these training modules, nothing I say should be taken as investment advice, and if it sounds like advice, it's actually not. It's just my opinion. I like to start every conversation on investing with the question, why do we invest in the first place? So in this case, why do we invest in stocks? And the reason, in some ways, is true for every investment. It's one way to potentially make a better return than bank interest or, say, a CD that's insured. And really, that's it. What we're doing is we're taking some other form of risk and hoping to turn that into a return. Stocks are obviously not the only investment, but they are one of the riskiest. They actually have two risks going for them. If you own an individual stock, or if you have a large concentration in your own company's stock, you're exposed to both company risk, the individual company risk, as well as overall market risk. If we own a portfolio of stocks, easy way to do that is simply own a mutual fund, then that reduces the individual company risk quite a bit, but it still leaves market risk. And sometimes stocks are a good investment. In other words, sometimes we get paid to take market risk, and sometimes not. What can happen in a lot of cases is that we fall into this trap of thinking that stocks are the only real investment. And this is driven mostly by the mutual fund industry, which is an enormous multi-trillion-dollar business. And particularly since many people's primary savings is a 401k, we've gotten used to the idea that the stock market is really the only place to make money, and it's the only place for our retirement savings. This is also driven by the entertainment of stock investing. There's whole TV networks dedicated to just making people follow stocks and making a lot of money off of that. So what I'm going to try to do in this module is take a look at the logic behind that, see if we can blow up any of the myths, and just develop some clear thinking on why we invest in stocks in the first place. Rather than make you wait till the end, I'm just going to give you the keys to successful investing right up front here. Number one, diversify. Number two, when you think you're diversified, then diversify some more. And what I mean by diversification is owning investments that do different things, that make money in different ways. And we'll talk about how that applies to stock investing in a minute. So number three, develop a philosophy and a strategy. What I mean by philosophy is figure out what it is you believe about the market. Do you believe that stocks always go up? Do you believe that if you hang on through the dips and you have enough time that you'll always be okay and accomplish your goals? And then once you figure out what you believe about the market, make sure that the strategy you're following is in line with those beliefs. What can cause a lot of stress is when people have certain beliefs about the market and then they hire an investment advisor who has different beliefs or follows a strategy that's not in line with the client's beliefs, and then there's just never a feeling of being settled and comfortable with the investments. I think keeping losses to a minimum is very important. I think one of the things that can destroy a retirement plan the quickest is to absorb the large losses that can and will happen in the stock market. I think it's important to keep those losses to a minimum. We can't avoid them altogether, but we can minimize them. Ignore what you hear on TV, and just remember that when Jim Cramer is talking about stocks, when any of the other talking heads on CNBC are talking about stocks, they're being paid to be entertainers. And so their job is to keep you watching. Just keep that in mind whenever you hear stuff on TV. And then ignore anything that concludes with buy gold. If you're watching a PowerPoint presentation on the internet that you can't fast forward through and takes 40 minutes to finally get to the end, at the end they're going to recommend buy gold and buy our newsletter. They're trying to sell you something. So don't let it concern you, and just the easiest thing is just ignore it. So these are all real good keys, but there's one primary one that I'm going to give you right here, and that is stop watching the market. This is probably the downfall of the greatest number of investors. We have to remember that investing in stocks is part of accomplishing our financial goals. It's not a competition. So by constantly watching the market, we'll always feel like we're falling behind or we're missing out. That somehow we turn stock investing into a competition. Stocks are just one of the vehicles that will help us accomplish our financial goals. And those financial goals do not include keeping up with the market. So the best thing that we can do, not only to, I think, maximize our returns, but certainly to reduce stress, is simply stop watching the market every day. On this slide, I want to address 3 methods of common stock investing and take a look at the pros and cons of each one. And the first one is actually the fastest growing strategy right now, and it's low cost, what we call indexing. So this is owning a fund that represents an entire industry or entire segment of the market. Maybe it's a low-cost mutual fund that just holds the stocks in the S&P 500. There's no manager behind it. It's a static basket of stocks, and so it's very inexpensive, and it simply follows the market. On the downside, there's no risk protection. In fact, it's about the opposite of risk protection, and therefore it relies completely on the market to go up, and it relies on historical data. What I mean by that is the theory behind indexing is that history will continue to repeat itself forever. In the past, anytime the market has gone down, it's always come back up. Unless you take a look at places like Japan and a few others. But this is the, at least in the US, it relies on the fact that history will continue to repeat itself forever. That's where I have a little bit of an issue with simple indexing. The second one here, owning actively managed mutual funds. In the past, this was by far the most common. It's starting to fall out of favor now because actively managed funds have really not had a good track record of outperforming the index. But we do have to make sure we know what we're talking about when we say active mutual funds. These are funds that have managers that are trying to outpick the index. So if they're successful, it's possible to outperform the market. Again, they don't have a very good track record of doing it consistently. But that does mean you're a little less dependent on the market simply always going up. If they pick the right stocks, maybe they can go up for a little bit when the market's going down. Of course, that's vice versa is true as well. It depends on the skill of the manager, and I added in the luck of the manager here because it takes so long to statistically weed out luck versus skill. It can be 10 to 20 years of data collection and consistently outperforming the market to really weed out luck. So if you think of 1,000 people all flipping coins, it's likely that one of those 1,000 people will flip heads 10 times in a row. It doesn't mean they're any better at flipping a coin than anybody else. Also, we have to keep in mind that when a manager is managing a mutual fund, those mutual funds often have constraints that are built into the definition. A very common one would be that they have to maintain at least 80% exposure to the market. They have to stay 80% invested at all times. So there's just certain constraints that the managers have to follow. The third one would be some form of actual risk-managed investing. Risk-managed investing means that there's actual tangible methods of trying to minimize losses. And so this form of investing is really, the benefit is not going to show itself until there's a market down cycle, which there will be at some point. Where we're at right now, however, in 2017, is we haven't had a down cycle in over 8 years. And so risk-managed investing has fallen out of favor as people are starting to get used to the idea that we'll never have a down cycle again. On the downside, I say it's difficult to handle emotionally, and the reason for that is exactly the case of the last 8 years. If you do risk management, if you have the ability to outperform the market by minimizing losses, then you will also have the probability of underperforming the market when the market's just going straight up. And that's very difficult to handle emotionally. You have to remember that stock investing is not a competition, and that it's important to have some risk management. And again, going back to our developing a philosophy, you have to believe that that's important. In line with that, one of the things I like to remember, or I like to think about, is that cost is really only an issue in the absence of value. So if you believe that minimizing losses and having active risk management is valuable, then it's worth the cost. In some cases, of course, it can be too expensive as well, but it's kind of contrasting the argument of people who are firm believers in indexing, which would say no matter what, it's the cost of the fund that's the most important thing. And I think it's okay to pay some cost, provided that we're getting value out of it. One of the goals of this module was to think through some of the logic behind stock investing, and part of that is addressing what I think are some of the myths behind stocks. I also find these somewhat annoying. The first one here is what I was just talking about, the idea that cost is everything. And that was really driven by Vanguard. It's what put them on the map and their funds on the map. I like to rephrase cost is everything by saying risk management has no value, which is really saying the same thing. If risk management had value, you'd be willing to pay something for it. And what Vanguard and all the others who strongly advocate indexing is that risk management has no value, that really it's cost. That's the only difference between funds and strategies. What they stand behind in order to prove that is this idea that active management always underperforms benchmarks. There's a lot of data that actually says that's true. However, the data and the studies behind that used a small subset of funds. They were only looking at funds where the managers are trying to outpick the index. And sure enough, there's actually a fairly poor track record of being able to do that successfully over long periods of time. But that was a subset. It was cherry-picked data, and the conclusions were then broadened out to cover every fund and strategy. And as an engineer, that bothers me. Another myth goes hand in hand with all of this is the idea that the market always goes up if you give it enough time. Again, if we look historically, we can certainly see that that happens a lot of times, but the market doesn't care about my time frame or your time frame. This also makes the assumption that if you have a big dip, then you can always stay fully invested in order to recover those dips. But as we get older, we're also supposed to be taking less risk in the stock market. So what happens if the timing doesn't work out? We get a big dip right about the time where we really should be starting to get more conservative. Well, so that doesn't always work. The assumption behind all of this is that if you have enough time and enough patience, then you can ride out the dips, and when you need the money, when it's time for you to retire, the market will have come back and given you the return you need. And statistically, that cannot happen for everyone. And so that's why this whole idea that simply given enough time and patience that it will work out for everyone is a myth. If you haven't figured it out by now, I subscribe to the risk management philosophy of investing. I think that over our investment lifetime, if we're able to avoid the major drawdowns, then we stand a much better chance of accomplishing financial goals over time. But why is risk management so hard? As one of the downsides, I said it's very emotionally difficult. And so I want to give an example of a sector strategy that I was using fairly early in my investment advising career. This is a sector strategy I developed that just evenly invests in all of the major sectors of the market. There's 9 of them. I would then follow the performance of each sector, and I had rules that said if it enters a downtrend, I go to cash, and when the sector recovers, I move back in. So this is a simulator I developed that can do a back test going back to beginning of 2000. It's a little dated since I haven't updated it since 2013, but it shows the point. So back here in the dot-com crash, the signals would have told me fairly early to get out of technology, and that's why actually the performance would have gone up a little bit. But eventually all of the sectors broke down, and so I ended up, would have been completely in cash, and then when stocks came back, I get invested again. Same thing in the financial crisis, 2008, 2009. All of the sectors tended to deteriorate fairly quickly, and so the model would have gone into cash, and when stocks recovered, I get fully invested again. So it looks pretty good. In fact, when we take a look at the numbers, over this 13 years, the sector strategy would have returned over 7% annually, where the S&P was only about 1.6. And so where the S&P over this time frame only would have given you a 23% total return, the sector strategy would have well more than doubled your money. So clearly this is a better strategy than simply investing in the market. So why is it that I don't use it today? And in order to show that, I want to zoom in on just this portion of the chart. Here's the picture of that zoomed in section, and you can see that the strategy looks very different in this time frame. This starts right at the bottom of the financial crisis when stocks started to recover. And for any strategy that can go to cash, it takes a little while to figure out when to get back out of cash, and so during this time frame, it lagged the market. If I want to make it look even worse, I can zoom in even tighter at that beginning section, and you can see market was up almost 40% before the signal said to get back into stocks, which, as odds would have it, was right when stocks decided to do a little pullback. Very difficult as an investment advisor to stick with this strategy while you're trying to preserve your business, and it's obviously very hard as an investor to watch this happen. So this isn't the only risk management strategy. There's lots of them that all look great when you zoom out 15, 20 years over an entire market cycle. But what I've learned over 11 years of being an investment advisor now is that investor emotions are at least as important as having the right strategy. We have to pick a strategy that can provide downside protection, but also be one that investors can survive. And we'll talk about specifics in part 2. One last thing I want to address in terms of the logic that goes behind investing is the whole topic of stock diversification. Conventional wisdom would say that in order to have a diversified investment portfolio, you need some large companies and small companies, and US and foreign, growth and value. So what I show here, again, the chart's a little bit dated, but it still shows the point pretty well, is over 5 years, how stocks correlated during the financial crisis. So the whole idea behind diversification is that it's supposed to provide some protection. In fact, for indexing, it's the only protection. But you can see when you get a big downtrend in the stock market, they all behave exactly the same. And then as stocks recover, you start to get some separation. And again, conventional wisdom says, ooh, look, we're getting diversification. But notice that the direction is always the same. Maybe over a certain period, one asset class here outperforms another one, but give it enough time and they eventually swap positions. But there's nothing here that zigs when the other ones zag. If you're owning stocks, when stocks go up, they tend to all go up. When they go down, they all go down. And so what we've gotten to think of as diversification is not actually giving us any protection. And I've just found this chart to be very helpful in demonstrating that. Some people find math a little more compelling than just a picture, so I thought I'd give you some actual statistics. And keeping in mind that to be truly diversified, we've got to have some investments that zig when the other ones zag. If they all move in the same direction, it really doesn't help us much, particularly when things go bad. So in this case, what I've done is taken a look at most of the major asset classes, pretty much all of them, over the last 10 years, and this is as of 2017, so this is looking back 10 years, and by correlation, we're looking at how much statistically do these stocks move together. And take a look over 10 years at how many of these different asset classes correlate with each other 90% or more. Conventional wisdom would say that if you own some of all of these asset classes, that you have a diversified portfolio. And yet, the best non-correlation that we have are these two that are at 80%, but they're still 80% correlated. And so I think by any stretch, you're not getting much diversification here. And yet this is the conventional wisdom that says if you own all of these, you've got a diversified portfolio. That brings us to the end of this module, and its purpose was really to show the rationale and the logic behind the portfolio, or the stocks section of portfolios that I put together. And the key for diversification, which is very important, but the key to real diversification is that we have to have investments that earn their return in different ways. They have to do different things. And most funds do one thing. They either own stocks or they own bonds. And so no matter how many of those you have in your portfolio, if they're all doing the same thing, you're not getting any real diversification. If you're going to own a fund that does its own risk management, it does take quite a bit of effort to understand the fund strategy. I think it's important to talk directly to a fund manager. A lot of them are not willing to do that for individual investors, but if you're uncomfortable handing the reins over to an investment advisor, then a perfectly reasonable shortcut is to go the low-cost route and own index funds. That's perfectly reasonable. In the next module, we'll talk about some of the specifics in terms of what I do to implement the stock portion of a portfolio. And with that, we will wrap this up. Thank you very much.